So everybody, thanks for making it in with the weather and everything else, and try to get this event started so we can get all back to our jobs and trying to make some money. Welcome to the 2013 Client Appreciation Breakfast, and really the goal is to say thank you. You know, we appreciate the opportunities, appreciate the business we've had over the past several years, and maybe try to give everybody a high-level optic from our two presenters today. We got Asieh Mansour, who's the head of global research for CBRE, and we have Spencer Levy, the executive managing director, heading up capital markets. So I'm going to, with that introduction, turn it over to these two, and maybe do a little Q&A afterward, or any interrogatives you want, during the presentation. Please feel free.
Great. Well, thanks, Bill. Thanks for having us, and on such a beautiful day. We appreciate the wonderful weather. I was mentioning to some of the folks in the audience that I've gotten stranded because of the weather before, and the last time I got stranded, I was stranded in Vegas for a week, and so maybe I get stranded in Detroit today for a couple of days. So, but in any event, thanks for having us. Asieh and I do this type of talk regularly around the country. And what we like to do is to talk both big picture about what's going on in the world, what's going on in the U.S., but we really try to make it hit home here, what's going on in the greater Detroit area, to talk about your market and how what's happening in a macro sense is relevant to not only institutional investors, but local investors as well. So with that, Asieh, what's going on in the world? And give us your big picture overview.
Sure. Well, first of all, thank you and good morning. And maybe, one of my views, if I were here 20 years ago, I would just focus on what's happening locally in terms of the economy in Detroit. But one of the points that I always make is that where we are today in 2013, we are so much more integrated globally. So even what's happening in Greece, maybe Greece will exit the Eurozone or not, definitely has implications not only on a global level, but on a U.S. level and on a, for this market as well. So we are so integrated, especially with real estate with respect to the capital markets. We really feel that's the first place that we feel it. In terms of the outlook, let me just start globally. There were three major, I would say, exogenous factors. I love using that,
That's a big word, Asieh.
That's a big word. There were three factors that I think really impacted us, and there were headwinds. One was what's happening in the Eurozone. The Europeans have been living beyond their means for a long time. Their public debt to nominal GDP number is very high. It's a day of reckoning. So they have to go through austerity, and they had some of their financial crisis and some of their debt issues. So that's one thing. It seemed that that's been corrected, at least where it's not on the brink of disaster. So that's one factor that was a headwind last year. It seems like it's easing. The second was slowdown in the emerging markets, especially with respect to China. There was a lot of fear that maybe there's going to be a major slowdown in China. I think that it's not. It seems more of a slowdown. Some of the numbers we got, especially today with respect to Chinese exports and imports and some of the manufacturing number, China's actually doing better than expected as well. So that second major headwind, I think that's dissipated as well. And then the third, discussions domestically about the fiscal cliff. And I'm sure you've all heard so much about the fiscal cliff and what the impacts are, especially within your region. It seems that we got some partial resolution. There's still some talks, and we'll talk more in detail when we focus on the U.S. But there seems that the markets, at least the equity markets, expect that there will be a deal, maybe not a grand bargain or grand resolution. So those three major headwinds, I would have to say, have gone away. So I think the prospects for the global economy and the U.S. have improved.
Well, I would agree with Asieh's point of view, but what I do most of the time is I speak with institutional investors, not only here, but I travel internationally as well. And in addition to the actual decreased risk of some of these exogenous factors, using Asieh's words, being a problem, I think also investors have gotten a little bit inoculated to it. There's my fancy word for the day, Asieh. Because investors are getting tired of talking about China, they're getting tired of talking about Europe and the fiscal cliff. And I would say tired, not because they know it doesn't exist, but they know they can't solve it. And so because they've gotten to this point where they believe it's more of a chronic disease than one that's going to take you over the edge tomorrow type of disease, we've seen a remarkable rebound in investor sentiment from around the country. We've also seen a remarkable rebound in lender sentiment around the country. I was mentioning to some folks in the breakfast area that I just got back from the Mortgage Bankers Conference in San Diego on Monday and Tuesday, and it was borderline scary how optimistic many of these lenders are, not only for core deals in major markets, which has always been the case, but even for markets that are outside of the gateways, even markets like Detroit. If you have a stabilized asset in this market, you're going to get a tremendous number of very competitive, high leverage loan quotes that are not that different than the kind of loan quote you're going to get in Chicago. I had 2 lenders independently come up to me and talk to me about deals they're doing in North Dakota. North Dakota. I mean, who lives there? But the point is that the lenders are looking for deals where deals are occurring, whether it be in the gas boom that's happening up in North Dakota or someplace else. So I think the bottom line is that we are in a period here of, I wouldn't go so far as to say scary optimism, but it was far more optimistic from both an investor and lender standpoint, notwithstanding many of these factors that Asieh suggested. So Asieh, with these big factors out there, what is your outlook for the United States in commercial real estate?
Well, it's just starting with the economy on a national level. I think we grew last year, 2012, about 2%. I think when the numbers come in, if Hurricane Sandy hadn't occurred, we would probably be closer to 2.5%. I'm sure you noticed fourth quarter, the preliminary estimate came in negative, 0.1, showed a contraction. I don't take that seriously. I think it was just more due to temporary factors. So 2% for 2012, way below subpar, given where we are in the stage of recovery. So it just doesn't seem like it's a recovery. For 2013, I think the first half is still going to be tough. I think it's going to be challenging. Taxes have gone up. I mean, it is impacting consumer spending. There's still the question of what's going to happen to sequestration, the budget cuts. We don't have a resolution yet. I think it's, one thing I've noticed with Washington, everything happens last minute. So it comes down to the midnight hour before there is. I do believe underlying our assumptions for growth for 2013 is that there will be some resolution. And the debt ceiling, they just kick the can down the road again. So for the first half, our expectation is maybe 1% to 2% growth because of that uncertainty. But really what I believe, I'm taking, I always used to say cautious optimism. I think I'm taking cautious out of that cautious optimism. I am optimistic now that the second half of this year for the U.S. is going to be much stronger than we've ever felt. It's going to be both stronger in terms of growth, GDP overall output growth, and in terms of job gains. And 2014 is really the year that the U.S. economy is going to be working on all cylinders. And the reason I believe that is many of the excesses that we had in the 2007, 2008 downturn, the credit bubble, the housing bubble, they've dissipated. So I think for the for the U.S. economy at least, the second half stronger. And this is going to have implications. So before I talk about the commercial real estate, do you agree, are you as optimistic about prospects for the U.S. economy given the people you're talking with?
Well, I would say that the people that I'm talking with are ahead of the curve. I think their optimism, if on a scale of 1 to 10, your optimism, would you call it a 6?
7.
7?
Yeah.
I would say that the people that
you're talking about.
the lender that I was speaking to, their optimism was 9.5. In fact, it was so high among these lenders that some lenders were quietly saying their underwriting standards are back to 2006. They're not back to 2007, they're not back to 2008, but they're back to 2006. And you can get debt capital now for not just the core deals, as I suggested, it's going outside of that. Moreover, the institutional investing community, every institutional investor that I've been speaking with, and I spoke to several large pension fund advisors yesterday, they all want deals in secondary markets. And secondary markets, let me define that, stabilized non-core. And the reason why they want that is there's this tremendous inefficiency in the marketplace that the cost of debt and the amount of leverage you can get in a secondary market is about the same as what you can get in a major market. And a lot of people want to exploit that for the benefit of markets like a greater Detroit area. And so I would suggest to you that they're very optimistic. The institutional investors want to get into these markets because they can't get the yields that they're looking for in the core markets. International investors are beginning to look at these markets as well. I just got back from Tel Aviv about 2 weeks ago, and I met with 15 different institutional investors there. They all want to come into these types of markets as well. And so let me temper that just a touch, saying that there's stabilized non-core in secondary markets, and then there's value-add deals that have a tremendous amount of leasing risk or other capital risk associated with them. I don't think the capital markets have quite moved there yet. When we were at the peak of the market in '07, you saw people paying as much, if not more, for vacancy than they were for stabilized occupancy. The market is not that optimistic yet, but the market has improved to the point where people are taking a very, very hard look at stabilized assets in secondary markets.
And I think that in terms of the real estate fundamentals, and I have to say the real estate fundamentals, the improvements in occupancy have not been as strong as we would have hoped for. The only sector that we see occupancy gains tremendous and vacancy rates back in equilibrium is the multi-housing sector. So from a fundamentals perspective, the commercial real estate, multi-housing has done extremely well, especially multi-housing assets located in inner cities because of the lifestyle choices, and then the echo baby boom generation, which is reaching that age to be renting. But if you look at office, industrial, and retail, they still are suffering from high levels of vacancy across the country. There are some markets, like the tech-driven markets, energy markets, healthcare-driven markets, that are doing better, especially Class A office and CBDs is doing much better from a fundamentals perspective. But there's still a lot of legacy vacancy, especially in retail. Shopping centers are the laggards in this recovery, and I think we still need a couple years of strong economic growth. But I think the trend has been right. We're, again, seeing steady improvement. But I think the sense of optimism, Spencer, that you breathe from a capital market side, the fundamentals have yet not done as well. We are seeing a movement from being a tenant market, an occupier market, to more of a landlord market, but it's really happening in some of the key gateway markets that are driven by, again, tech and energy. So it's interesting that the capital markets are ahead of what's happening in the fundamentals.
Well, I would argue that capital markets are always ahead of the fundamentals. Why let the facts get in the way of a good argument? Because I think at the end of the day, if you took a look at what happened during the last boom period, between 2002 and 2007, the average office building in the country doubled in value. 95% of that was cap rate compression. 5% was actual increase in NOI. And so, but then when the spigot turned off in late 2008, cap rates expanded and values dissipated. We're seeing similar cap rate compression now in major markets for multi-housing deals, for sure. And then multi-housing is the one sector which objectively is not ahead of fundamentals. The fundamentals there are incredible.
Right.
You're seeing 5 to 10% rent growth. You're seeing stabilized occupancy. But to Asieh's point, in those markets that have strong employment bases with a diversified economy with things like education, healthcare, energy, tech, you see in the other asset classes also pockets of strength. So you take a market like a Midtown Manhattan. Midtown Manhattan is doing okay, but there is a subsector within Midtown Manhattan where Google just went to, that Google is now drawing all these other tech tenants towards it. So it's in Midtown South, and Midtown South is actually a historically less favored part of Manhattan. But that may be the strongest part of Manhattan right now because tech is drawing all of those tenants there. You're seeing the similar thing. I made the comment about North Dakota. Energy is an example of where it's happening. The other two areas that people talk about are healthcare and education. Education is something that actually scares me a little bit today, Asieh. It scares me because a lot of these education institutions are highly levered. They're losing or they're at risk of losing student bases. And so, I see Ann Rom in the back of the room here. We may see some interesting financing happening at some of these universities with sale leasebacks and otherwise because, I don't know that they're going to be the same type of employment and driver as they've been historically, largely because of their financial situation.
Yeah, I wouldn't disagree. I think that that's an issue. I think the student loan problem is that the students are just the student loans are so much that it may even prevent many students from going for higher education. I think education long-term, we've always touted the U.S. as an engine of job creation, the education services, not only for domestic U.S. Families and children and students, but even globally attracting a lot of foreigners. I mean, I'm a poster child for coming to the U.S. for a graduate. But even now, the universities around the world, there's just so much choice that I don't even think that the U.S. right now, I mean, it may not be just by choice, that's the only choice you have. So I wouldn't disagree. And I do think that we're seeing, especially with student housing as an alternative to invest, we are seeing a lot of the universities privatize some of their housing, off-campus housing, as a way to shore up their finances. But I would agree that I don't think it's going to be as strong of an engine of job growth as we've relied on. But healthcare is a different case. And I have to say, with healthcare, not only is the demographics of the U.S. changing in terms of the aging of the baby boom generation. The baby boom generation still has a lot of discretionary disposable income. They will spend a lot more on healthcare. So demand for healthcare services is increasing. Also with the Affordable Health Care Act, Obamacare, you're going to see an additional 30 million Americans have access to health insurance. That's going to change the dynamics of demand for health care. We'll need to, as a society, provide more healthcare services. So I think with healthcare, with respect to healthcare, I think you will see expansion in jobs. It's one of the fastest growing, we think, if you look at the outlooks that we get from moody'seconomy.com, the sector that's going to create the most jobs over the next 2 to 3 years is the healthcare. So healthcare is still going to be one of the main engines of job growth.
So looking back now on the capital market side, there's a couple of factors out there that are driving what I suggest are perhaps outsized optimism among investors and certainly lenders. And the biggest driver is interest rates. But also hanging out there is the risk of inflation down the road. So Asieh, what's your outlook for interest rates and then inflation?
And Spencer asked me this because I think he's heard me I'm off consensus. I'm out of consensus about what's going to happen to inflation. I do think we have a much more inflation problem than currently investors are underwriting. Mm-hmm. So here, if I can just take 2 minutes to explain my interest rate forecast, because interest rate forecasting is very difficult. If I had built my career on forecasting interest rates, I would have no career, because it really is such a difficult variable to forecast. But our 10-year yields, 10-year U.S. Treasuries, that is the benchmark that we as a society look at the U.S., because we retired the 30-year bond. So it's here the 10-year bond. In any sovereign country, the 10-year yield has to match nominal GDP growth in equilibrium. What is our nominal GDP growth? It's inflation. Our headline inflation right now is 3%, plus real GDP growth, which 2012 came in at 2%. So if you add 3% and 2%, 5% says if we're in equilibrium, that's what the 10-year yield should be, 5%. Where are we right now, Spencer?
I think the 10-year may have just creeped over 2%, but sort of hovering between.
So we're 2%, and the Fed is distorting that pricing signal. We're at 2%, where we should be 5%. So I think clearly, if the economy gains traction, if my forecast or what our expectations, our house view is for the economy, you're going to see interest rates go up. So part of it is interest rate. I think that the interest rates should reach that 5%, which is the equilibrium where we're in a more normalized period of growth. But also inflation. Inflation is going to drive higher nominal interest rates. Up till now, we haven't had inflation. I would say for a variety of reasons. One, even though the Fed has injected a lot of liquidity, there's been so much uncertainty on behalf of investors that they've been holding on to cash. Banks, they've been holding on to cash. They haven't been easy, and the money has not filtered into the real side of the economy. That's going to change. Once there is more certainty, it's going to change. Second, we've had disinflation from the global trade patterns, from China. Look what's happening to Chinese CPI. I think they got the number. The Chinese are now worried about their inflation. So now, not only is trade not going to be disinflationary, it is inflationary. And the third thing is that I have to say is I don't believe the BLS numbers on CPI. I don't know what they do. They keep changing their methodology. But I'm telling you, if we use the methodology that we were using 5 years ago, we would have inflation rates that are in the higher single digits right now.
You're suggesting the BLS is politicizing CPI?
I'm not saying that they're lying, but I'm just saying that I don't believe the methodology that they're using is accurately reflecting what the true costs are. If you look at services, I see inflation everywhere I go, but I don't know why it's still not being reflected. And I think part of it has to do with the housing prices. Go ahead. Yeah, yeah. So I just, that's the thing. I just don't know how they're doing their methodology. I don't think inflation headline is just 3%. So higher interest rates and higher inflation. My expectations.
Well, I would generally agree with you on the interest rate side of it. On the inflation side of it is very hard to predict at this point. But you look at consumer goods, you are seeing the increase. But as noted by the gentleman in the back, real estate, you're not seeing it, certainly not for the sticks and bricks, but you are seeing it for anything with stabilized yield. You're seeing cap rates at peak at this point. But interest rates, even if they go up, and this is the kind of comment that gets me thrown out of these conferences, I think rising interest rates is actually a good thing for our industry, because rising interest rates will unleash certain things that are currently trapped. Specifically, there are a lot of buildings that have long-term debt still in place on them, and the owners would love to sell. A lot of them, particularly in the so-called distressed asset types. They can't sell them because if they were to sell them today, they'd have enormous defeasance penalties, yield maintenance penalties. They just can't pay them off. And so with a rising interest rate environment, these defeasance penalties, yield maintenance penalties get much lower. It becomes more economically practical to grow. The other thing that I think is more important is that our Fed has been explicit that they're not going to take their foot off the gas of monetary easing until we see an improving jobs environment, so that rising interest rates are going to go hand in hand with a better economy. So a lot of good things will happen when interest rates go up, despite the fact that your cost of debt capital will be impacted by it. But the inflation thing, I mean, at the end of the day, commercial real estate, to the point of the gentleman in the back, has always been a great inflation hedge, or at least it's thought to be a very good inflation hedge. So even a little bit of inflation is not necessarily a bad thing, and it probably will filter to some degree into commercial real estate.
No, I totally agree. It's an inflation hedge. I think this is the time that, one of the things that I'm hearing in the market with investors, there is a great rotation out of bonds. I think investors are sensitive to what's going to happen to the bonds. There is a movement to more real assets and equities, and I would agree that if we do get inflation, higher interest rates, I mean, I don't fear higher interest rates. I agree, because it's hand in hand with recovery. And I think if we do even get inflation, I think real estate is a great sector, especially short duration real estate assets do perform much better in an inflationary environment.
Mm-hmm. Well, Asieh, you mentioned real estate fundamentals are lagging in office and retail in particular, but multi-housing is doing well. Industrial is sort of a mixed bag, depending upon whether it's a logistical location or not. But Bill, let me ask you a quick question. How are fundamentals here in Detroit?
They're strong. I would say as strong as we've seen in a long time. The automobile industry has rebounded since we had our troubles back in the '08 era. Multifamily, just to touch on the major food groups across the board, multifamily here has continued to move forward. Occupancies have remained high, especially in the Class A and B products. We're seeing moderate rental growth. We're not seeing the 10, 12% that you were mentioning. Probably the brightest spot here in Metro Detroit is the industrial sector, the warehousing or flex building space, where it has all been but absorbed over the past 12 months. So, rental rates that were maybe down at a $2 a square foot low to maybe high as $6, with new construction costs being $70 to $80 just for the vertical, not including the land, you're going to see those rental rates rise pretty steeply. In order to build new, you're going to have to charge $7 to $8 a square foot. There's really only a couple Class A and B 100,000 square foot spaces available, although there's only two actually down in Romulus. So there's spec building going on. I talked to an owner developer in Highland Park. He's thinking about building up to 300,000 square feet spec. I know of 3 different build-to-suit opportunities with 150 to 200,000 square foot flex type of buildings going up. So I'd say locally that's been the brightest spot. And retail continues to chug along. I think you're going to see, with consumer spending maybe decreasing to some degree, at least for the first half of 2013, that's going to just continue to chug. No real new development in that area, so I think rental rates have been flat to declining, albeit a lot of the inventory that was sold at distress levels has worked its way through the marketplace. So that bottom, I think, has been realized really towards the end of 2012 as well. And office has been improving locally. I think overall vacancies increased about 3.5%, and then the downtown sector with Dan Gilbert buying up 20 plus buildings and a couple other transactions that have happened. I believe the downtown office occupancy CBD increased about 7%. So all positive signs. Nothing really is going backwards at this point.
What I like about your answer is that there is some development going on, but it's based upon, generally speaking, fundamental demand. Even the spec development in the industrial space. I made a comment in one of these things a few weeks ago where I mentioned that what I consider to be crazy is that we're seeing spec development in some places that has no relationship to fundamental demand. And the one area that I point to is Miami. They are doing new spec condo development in Miami today. I mean, think about that. You think about, wow, they're going to lend in North Dakota, might as well do a spec development in Miami. So, but the reason why they're doing that is that the capital markets create what I would call an inefficiency. They will create the demand for product even if they don't need the product. And in Miami, the reason why we're seeing demand for new product being built is because there's a lot of capital flight that's going on in the world. A lot of these issues that Asieh referred to at the outset, whether it be in Europe, China, or elsewhere, are leading capital from Latin America, particularly into Miami, and from Southern Europe into areas that are deemed to be safer than keeping it in the current local currency. And one of the net beneficiaries of that are condos in Miami. You're also obviously seeing that for condos in New York as well, but New York condos have good fundamental demand beyond just capital markets demand.
To your point, Spencer, and again, I'm interested to both of you, is as I've studied the Midwestern markets, I've found that development in Midwestern markets has been more conservative. They haven't, to your point, I don't see rapid speculation. I think the banking environment, the financing environment, they say, show me the tenant, show me the demand before I give you the construction financing. And that's very different from what's happening on coastal markets. And as a result, I do see that why investors may be interested in the Midwestern markets, because it's not as cyclical. You don't go through those periods of overbuilding. Much of the new supply is in line with underlying demand. And Detroit is not the only market. I think in general, but in general, this is what I'm seeing in the Midwestern.
I absolutely agree that, in the Midwest, it is much more conservative. We don't see the massive swaths of cap rate and price changes that you maybe see in the Smile states, the coastal states. And the development really is tenant more driven than anything else.
And this may make it much more attractive now as investors, as to your point, are fanning out beyond primary markets. This is an attractive quality for some of these markets.
What I would add to that is, we talked about the inefficiency in the debt markets, which is to be used to investors' advantage and should be used because you're never going to find a more favorable environment for stabilized assets, whether they be core, non-core secondary markets than you are today. But there are other inefficiencies out there. And the single biggest inefficiency out there, from my point of view, is liquidity risk. The reason why people don't come to Detroit or Cleveland or Midwestern markets is they're afraid that when their investment horizon is up, they can't get out. And because of that, you're seeing in these markets very thin books of institutional bidders. As a matter of fact, once you get above, call it a $15 million trade, wherever the break point is here for institutional trades, very thinly traded. And so, but a lot of institutions recognize that today. And so a lot of the institutions over the last 10 years have been built on a model where they promise their investors an exit in year 3, year 5, year 7, a very defined exit. What we're going to see going forward is a lot of these institutions are going to be more cash-on-cash driven rather than IRR driven, okay? The difference between being cash-on-cash driven versus IRR driven is the exit doesn't matter as much. And so once you get a double-digit cash-on-cash return, a lot of these investors will hold longer. And so as that mind shift shifts for the investors from this IRR to cash-on-cash driven investment style, it will be a benefit to these markets, because then they are not only going to jump into the markets initially, but they're going to hold for a longer period of time, and more investors will come in. Having more investors is obviously a good thing, because it would create liquidity longer term, but it just brings more capital to these markets. The whole IRR thing, and Asieh, I'd like your point on that, is really a relatively new concept in finance. I mean, It's something that when I was taking finance classes in the early 90s, we really didn't even talk about it. It was all about cash-on-cash returns. It was all about other finance concepts. And I think investors realize that the IRR-driven investment style, it may be going out of favor. The other thing that may be going out of favor, and this is not necessarily the best news for operating partners looking for institutional investors, the fee-driven model, the model that dealt with promoted interests, that may be changing as well. It's still there. It's still the norm that if you're an operating partner and you want to bring in an institutional investor partner with you, that you're going to get certain market fees for managing, leasing the assets if you do that, and you will get a promote over an IRR. But I think a lot of these investors are changing and saying, no, I want cash-on-cash driven type of style. That certainly was the case over in Israel when I was there a couple of weeks ago. Almost every investor said, look, we're in this with partners that we want them to have skin in the game. We want them to be equal to us. The IRR-driven promote structure has not proven to be an effective investment style for many of these investors.
No, I totally agree. I totally agree. There's a lot of fee compression. A lot of the top institutional investors that I've worked and have experience with, clearly that's not the way they want to go. They do want to see higher cash. A lot of the pension funds that are in the real estate, they need the cash. They have pension liabilities. So, no, I absolutely agree. There definitely is a mindset shift away from just pure IRR.
Bill?
I agree. Most investors that I talk to are cash-on-cash driven, and to touch base on the exit horizon, the average hold period in Michigan is 27 years, and I think, in the go-go days, at least for like Southern California, it was 7. So just people tend to hold on longer. Not that they couldn't sell it and monetize it, hopefully at its peak value with longer-term leases, et cetera. So I agree 100%.
Well, I talked about two inefficiencies in the marketplace, one being the cost of debt capital, the other being liquidity risk. There's a third inefficiency in the marketplace that may also create opportunity, and I would call it political risk. And I was at a conference about a year ago, and I heard something I'd never heard before. There was a CEO of a major corporation up there and said, I can invest anywhere. I can invest in Australia, Canada, U.S. I'm not investing in the U.S. because of political risk. And shocking when you think about that, about the U.S.'s political risk, but we are seeing this show up in some of the rating agencies when they look at our bonds, for instance. But taking it deeper, if you're looking at the United States not just as a unified whole, but as a series of states, should you demand a higher return from those states that you perceive to have a higher political risk of things like raising taxes, risks of making it harder to do business? So Asieh, what's your point of view if you take a state like a California that may have a lot of great growth drivers but has tremendous fiscal problems, tremendous political problems, and you compare that to, say, a Texas, which has a much more open environment? Should you demand a higher cap rate if you're buying in California?
That's kind of a tough issue, honestly, to answer just with one answer, because it's a little bit more complicated. Part of my background is I studied years trying to understand regional development in different markets. Why is Texas doing or Houston doing better right now than Los Angeles, for example? And it's not simply taxes. It's not just simply the cost of doing business. So regions that outperform, the drivers of outperformance, so you can even think long-term for Detroit. the drivers of outperformance of one region or one state over another, one of them is taxes. So absolutely, Spencer, to your point, I live in California. The tax structure that we have, it is becoming prohibitive. So it is driving at the margin some of the businesses that don't have to be in California. Say you don't want to be within the high-tech cluster. We are getting reports anecdotally right now that they are moving out. But taxes is just one factor that lends itself to the growth of a local economy and, of course, the real estate performance of that local economy. The second is the industry diversification, the clustering of specific industries. So if you're in high-tech firm in social media and you want to draw a pool from the talented labor pool, you're not going to go to markets that don't have that high-tech cluster. So you're hostage to the Silicon Valley or San Francisco area for that respect. So the industry clustering of specific industries also determines whether you are going to stay or going to leave. So taxes is one, industry clusters is the other, and then immigration and demographic patterns. I think that I did a study a long time ago. Do jobs follow people or do people follow jobs? And the reality at the end of the day is a little bit of both, but at the end of the day, jobs follow people. And people want to live in California for whatever crazy people they may be, or, relative to, it may be the sunshine, it may be the quality of life, access to the Sierras, a host of reasons. It's the 24-hour nature of some of the cities that the younger generation, the echo baby boom. So I think taxes, definitely to your point, is an important variable, and it may impact at the margin the spreads between what you should expect, that risk premium. But I think that there are other factors that determine whether a region is going to outperform or underperform, and it's not just cost of business.
Well, another thing that I mentioned that often gets me thrown out of real estate conferences is your best friend is a tough zoning board at times. Because if you have existing stock in the marketplace, having the ability to build more is going to dilute you. And the greatest example of that is Texas. The greater Dallas market, and I guess secondarily, if you go to Georgia, the greater Atlanta markets have great attributes from a demographic standpoint, and certainly in the case of Texas, tax standpoint. But very often they build themselves out of being competitive. So, there's a price to be paid for having this completely open and free business environment beyond just taxes. And I see half the room shaking their heads when I said tough zoning board. People were prepared to throw things at me. But
no, I mean, it's been hard making money in Houston.
Mm-hmm.
Houston right now has fantastic, economics. The business costs are lower. Government Perry is inviting California businesses to relocate to Texas.
Mm-hmm.
There's a lot going on for Texas. But if you look at returns, and I base it on NACRE, the National Council of Real Estate Investment Fiduciaries, which has an index of real estate, direct real estate, unlevered core real estate returns. It's hard to show in the Houston numbers that you do better investing in Houston real estate than you do in a high tax state, granted, like California. And I think to your point is, you just don't have supply. You don't have that barriers to entry.
Mm-hmm. Well, looking forward for 2013, 2014, I'm going to ask Bill first, and I ask you, Asieh. We think that Detroit is a market that is on the upswing. It certainly has had its issues over the last years that are well documented, but the recovery of the auto industry, the relatively low cost of doing business, certain political changes that make it an even more business-friendly environment. So it's a market that is poised for a potential rebound. With that as a backdrop, Bill, if you're advising your clients today in this marketplace, what would you advise them to buy?
That's a good question. The opportunity, I think, most of my investors here are hands-on local people that can take advantage of infrastructure that they currently have in place and different expertise levels of churning around assets. So it's finding still the, even more today, but still available niche sort of value add, different opportunities. Apartments might be the most difficult sector to find that in, but some office in the suburbs, maybe even downtown, and retail opportunities, I think, that are over leveraged, where they just have to walk at some level, just due to the lack of refinancing capabilities. throughout the process. So I'd say, just due to the nature of my clientele locally, I think it's take advantage of what is a dwindling horizon on, the value add opportunities out in the marketplace.
Asieh, same question to you, having a
Well,
broader view, where would you buy?
and, Spencer, we've talked about this before. I mean, I think one of the secular trends in the United States is a re-centralization, and I noticed that the downtown area, you're trying the revitalization of your urban centers, and this is going across everywhere in the United States. And I think there clearly is a movement, both population-wide, that people in jobs want to be in inner cities. They want to be in more urban areas. So one of the things that I actually really like is more urban retail. I think we're under-retailed in urban centers. So I think if you were to ask me what is an opportunity going forward for different urban centers, that's one area that I would be interested in. And I don't know what your perspective is.
Well, I think that the cap rates for secondary markets are beginning to compress in certain areas. I know Bill and I talked a little bit about some of the best retail in the greater Detroit area. You can get some deals that have fallen below an 8 cap, in that high sevens kind of range. That same deal in greater Chicago would be in the low 6s. So you still have, call it 150 to 200 basis point premium to buy here. But if you were to take a look at that same retail center and just look at the demographic profile within, call it a small radius and a larger radius around the asset, it could be quite similar from a wealth standpoint, age standpoint. There's not that many demographic differences when you're looking at certain sub-markets within the Detroit market, within other markets, and that's an inefficiency that people should exploit, because I think that you're seeing this wave of institutional capital coming your way. Now, we've talked about the cash-on-cash story about, buy in suburban Detroit or suburban Cleveland or suburban markets in the Midwest for the long term and get your cash-on-cash return. But we haven't seen that cap rate compression yet. So you will have actually the opportunity to cash out quickly. What we saw in 2007 and 2008, we saw the cap rates for major markets and suburban market and secondary markets converge. There was an actual convergence. And right now that spread is still, as I've suggested, 200 basis points. And you can take advantage of that by this unbelievably low cost of debt. By the way, if you're going to do this play, don't do it through conduits, because you'll be locked out of that liquidity play 2 or 3 years down the road. But nevertheless, I would be buying as much stabilized 9-core as I can, but again, being very micro-market specific within these markets. Bill, what were you saying?
I answered the question more on what I would advise my clients to maybe more purchase based on their capabilities. But on the opposite side of that coin, I would say the why sell now story for well-stabilized, anchored retail assets or even office assets, based on where the cap rates are today, where the interest rates are today, although there's not a one-on-one correlation, but you would also see rising interest rates as, this is your window potentially to maximize dollars on those, flight to quality assets, and the same would go with, Class A, well-positioned, well-occupied apartments or student housing, which I think there's going to be a big bubble in the student housing as those cap rates aren't sustainable, and I see a lot of major universities increasing their own stock in that portfolio, where it's going to drive out maybe the more non-university owned units. So I think the why sell now story and being fiscally responsible to your partners and making a lot of money and selling it at the top of the market always seems to be the time to do it, and I would say arguably today is the time. Not to serve my own self, but it works.
Well, I'll ask Asieh one more question, and then we'd like to give about 10 minutes or so for questions from the audience. But, Asieh, what's your outlook? We talked about interest rates, we talked about inflation, we talked about optimism generally. We've gone through this unbelievable period of shakeup. What do you think is going to happen, and how is it going to affect your outlook for commercial real estate in the next 2 years in Washington and in Europe, China? What do you think is the actual outcome there, and how will it affect commercial real estate investing?
Sure. I think I am definitely much more optimistic today than I was a year ago. I think I just look at many of the imbalances that we had that drove us into the recession have dissipated. I think recoveries following financial crises, recessions take much longer, and we've been at it for a while. I do think that the U.S. is going to be one of the shining stars. I do think that the U.S. and the emerging markets are going to lead global growth. I think Europe still is going to have its problems. But with respect to the United States, I truly believe that we're going to see much stronger growth. There is some political risk. I do think that we need to get a resolution to the sequestration. That's going to have impact on some of the markets that have exposure to defense spending in particular. So a little bit that we're seeing absorption activity down in D.C., Maryland, Virginia. Those are markets that I would see at risk. But I think in general, we're going to see a pickup in jobs. And jobs is the key variable between the economy and real estate markets. And I think there's a number of reasons. The small businesses that really generate jobs, they've been on their backs. They've been facing uncertainty. And I think with some resolution the first half of the year, the small businesses have to hire. The underlying demand is coming back, and I think that's good for your market. So going forward, unemployment rate is still hovering around 7.98%. We don't see it come back to its equilibrium, 6.5% till 2015, but it's going to be on a positive trend. So acceleration in job growth. And for commercial real estate, constant improvement. I think we are in a very sweet spot for real estate because the underlying economy is improving, jobs are coming back, but at the same time, we're not seeing massive supply. So this is the time that I think we're going, and supply takes a while by the time you put your plans in, and we don't see anything in the pipeline really out, and we're not seeing massive speculative activities. There are a lot of build-to-suits out there. So I think this is going to be a sweet period for real estate, that you're getting the demand. There's going to be positive demand dynamics, but no real supply. So you're going to see an acceleration in rent growth. So the next couple of years, very good for commercial real estate fundamentals.
Mm-hmm. Mm-hmm. Well, the scariest words that you hear at these types of presentations, and I always tell people when you hear these words, grab your wallets and run out of the room screaming, is this time is different. And that's an argument I've heard quite a lot recently about different types of real estate. And people say this time is different because interest rates will always stay low. They won't. They will revert back to the mean, as Asieh said, to around 5%. But the one area that we keep hearing people saying this time is different, in a negative sense, and something that you should exploit as an investor, is in this value-add retail, value-add office. Every time there's been a recovery, a fundamental recovery, and I agree with Asieh's outlook that we're going to see a fundamental recovery slowly this year, but accelerating into 2015, is in these secondary markets. And you will see stabilization of many of these suburban office buildings that people are looking at today, with fear. I mean, there's real fear in suburban office nationally that will it ever come back because of all of these demographic changes of people moving back to the CBDs, young people wanting to move into multi-housing versus single housing. The mean will be reverted to eventually. That is the trend that has worked forever. And so this time is different is something I wouldn't believe. And so I'm very optimistic for the future, and I think you can exploit it by going into those areas where people are fearful today, not just stabilized assets in these secondary markets, but also those value-add transactions as well. So with that, why don't we open it up for a few questions?
Greg?
You seem to sort of pick like primary locations for areas of primary markets and secondary markets. But one of the things that I guess we're a secondary market, but one of the things that I see that seems not is that while I've seen a lot of cap rate compression, buyers
Absolutely. I met with almost every major conduit lender in the country on Monday and Tuesday in San Diego this week. And the constant theme was they want to go into secondary markets. They'll take lesser quality. They have to put out volume. Last year, it surprised everybody when the conduits did about $50 billion of volume. This year, the number that they were throwing out was $100 billion of volume. They're not doing that by doing office buildings in downtown Manhattan. They're doing that in $5 to $10 million slices in, and this is no disrespectful term, in secondary markets like Detroit. Detroit is not a gateway market. So the conduits are going to drive the ability to finance those deals. Now, you still have to cover. You can't take a true value-add transaction that doesn't do a 1.0 to 125 cover.
And I'm talking about like a supermarket anchored stable property that it's done. You know, at least it's 90%, but it's a $4 million loan where, you know, there's a lot of brain damage that's happened to them. And, you know, that was sort of a sweet spot for life insurance companies, small life insurance companies. You know, I don't know, maybe I'm not the sources, but I just don't see financing, and that affects the sale, you know, because the buyers, I don't believe, come back either. So I'm seeing like a, you know, whereas my quality assets are decent property, and your office is, it's got a great cap rate compression, and it's sort of an easy deal. But on a sort of a, how much, you know, that is still stable. You know, and I look at a million other deals that are just like that, and I can't believe the cap rates. Yet I'm not buying any of them that are 10 or 11 cap, but because I don't believe there's financing.
Okay. Where I see that, you know, it depends on, you know, what the stabilization is and maybe the quality of your grocery anchor in this instance. You know, are they S&P double B plus or better? If not, then it does get trickier. I do see and hear that, you know, lending for these types of assets that aren't double B plus anchored is easing up. Unfortunately, you know, and again, no disrespect to my hometown, Michigan is still redlined by many of the lenders, and we're the last ones to get it. I think this year, finally, from what I'm hearing from the NBA, which is all very fresh news, that it is going to ease up to some degree. So, you know, maybe not today, but in 3 months, and again, depending on what that rent roll looks like in the guarantees and how long a term are going to affect that. So we're last in line, unfortunately, and we were the first to get cut off. And it's still that way, but it's better. It's gotten better the past 18 months in general, and I think after the MBA, which seemed to be very positive from the brokers that I know that went out there, it'll get better, but it's still difficult to your point. There's no doubt. Yes, sir.
That's where you talked about increase in interest rate. So I heard you, I understand you, but just a couple questions. One is that interest rates go up, historically, cap rates are going to go up. One. For us that are worried about our loan values, that may be problematic. And the other is that as interest rates go up, there's, I don't know what the percent of the market is, but it's got to be significant that are still hanging on to floating rates. Mainly because they couldn't refinance out from their existing lenders because of the value problems. So if you couldn't go and fix your rate, you'd love to, but you can't. So here we are, we're going to hang on. We've been able to hang on because even, you know, 300 over LIBOR for 5 years, it saved us 2 or 3 points over 5 years, saved the deal. Wow. Interest rates start climbing up before rents go up. All of a sudden, we're not going to have cash flow to pay our debt. And now all of a sudden, you're going to see a ton more assets in distress.
Well, let me ask you a question. This is a classic example of the me versus the we. And I say it respectfully, by the way. in the me case, in the case of your specific answer, there's certainly going to be specific instances with floating rate loans where there will be some risk associated with a rising interest rate environment. But the we that I'm talking about is with respect to banks in particular. The most inefficient place in the world to hold a distressed asset is on the balance sheet of a bank or a conduit. Those assets are trapped there today. It's not just the developers that want to sell the asset because they have a yield maintenance penalty, as I was suggesting. The banks, like some of the biggest banks in this country, have bad banks set up that have hundreds of billions of dollars of assets that every person in this room would like to buy today, but they can't get at them. And why aren't the banks selling them? The banks aren't selling them because, number one, they have gotten tremendous government support. But number two, many of these banks borrow at a cost of capital that's even lower than yours. Their cost of capital is close to zero. So their cost of holding those assets is close to zero. What's the difference between now and the early 1990s? There's a lot of differences. One, we never saw an RTC-style clearing event. The other difference is that the cost of capital is so much lower today. Anybody know what LIBOR was back in the early 1990s, approximately? LIBOR, which today is 25 bips, around 5%. Think about that. If you're a bank and your cost of capital is 20 times higher, you're going to dump these bad assets because you can't afford to hold them. So you're correct. In individual cases, you are going to get hurt if you have this disconnect between a rising interest rate and your fundamentals don't catch up quite as quickly. Over the broader scheme, you will see fundamentals increase as interest rates rise. There's also not a one-to-one correlation between cap rates and interest rates, particularly in markets like this where you haven't seen the same level of cap rate compression. The area of greatest risk for interest rate increase is multi-housing, because multi-housing has seen substantial cap rate compression. We are trading consistently the best multi-housing assets below a 5% cap rate. How do you underwrite a 3, 5, 7-year hold if you do that, right? So you're right. There is risk with rising interest rate for individual circumstances, but overall, I think it bodes well for selling more assets and will be closely associated with an improving economy. Asieh, what's your point of view?
Yeah, I agree. I mean, again, down to the individual, I understand your point completely. It is the...
I think it's our market. As Craig said, you're not going out to get a non-recourse $2.5 million loan. It's not there. Very, very difficult. So you're probably with banks, and depending on when you bought it, your loan to value is probably over 75%.
Mm-hmm.
The bank's not going to give you a long-term fixed rate. You're going to floating rate.
Mm-hmm. Well, I'll tell you what I'm going to do. I mean, I just met with these guys 2 days ago. I'm going to shoot an email out to 3 of them on my way back to the airport saying, all right, guys, I've got a room full of people here in Detroit who've got stabilized assets that want your money. And let's see what they say. I'll give the information right back to Bill, and Bill will send it to all you guys. So we'll see what they say. Questions? Yes, sir.
No, I agree with you absolutely. I think the higher taxes that are baked in, the payroll tax cut, and then just in general, the progressiveness, the higher tax brackets, definitely is going to change the prospects for the economy the first half, but it will be a one-time hit. I think to your point, interest rates are really driven right now by the Fed. And the Fed, as Spencer mentioned, the reaction function of the Fed is to when they're going to raise interest rates is until when unemployment, they're targeting the unemployment rate. They mentioned that they want to see the unemployment rate closer to 6.5%. We're not projecting a 6.5% unemployment rate nationally until probably well into 2015. So I think in the near term, in terms of the Fed's response, they are going to be intervening in the market and keeping the Fed funds rate. But to your point, part of the reason why we're a little bit circumspect in terms of the prospects of the U.S. economy the first half of the year is to wait and see what the implications are for consumer behavior to the tax increase in taxes. Up till now, we haven't seen as negative. Up till now, actually, consumers have been much more upbeat than businesses, and consumers account for 70% of the U.S. economy. So we're watching them closely, and again, that's why we're a little cautious first half, but I think that's a one-time effect with the tax increase. They'll price it in, and we believe that other drivers of growth is going to set up for a much stronger growth the second half of the year.
Any more questions? Ms. Ram?
I think every market that has healthcare facilities and an aging population, depending on the demographics, you're going to see increase in services. So healthcare is one area that you don't have, it's not just necessarily a gateway market driver. I think it's going to be a key driver of many economies. So depending on your access to healthcare, the university structure around you, the medical facilities, the hospital healthcare facilities. And one thing that's going to be interesting, I think we're going to go a little European in our healthcare. That right now, the way the U.S. healthcare delivery system is either doctors' offices or hospitals, I think you're going to see a lot of that medical clinics, the use of doctors' assistants, maybe not necessarily doctors for everything. There's going to be a whole change. So, no, I do think that it's going to benefit and drive job creation across non-gateway markets as well.
Okay. The gentleman over here.
Steve? Spencer, you scoffed at North Dakota 2 or 3 times, which obviously is being, the tremendous growth that's going on there is driven by energy, which is one of the underlying factors that's influencing our growth globally. Do the institutions scoff at North Dakota? Is your scoffing at North Dakota right now? Believe it or not, even us here, we've been approached with real opportunities to either build or development activity out in North Dakota.
Well, I scoffed at North Dakota because I had hoped there was nobody here from North Dakota, but clearly you were born in Fargo and I have offended your sensibilities. So I apologize for the great state to the north, which has a wonderful 3-week summer period. But no, North Dakota's a fine place. No, but the point is that, look, real estate is 2 things. Real estate is sticks and bricks and bonds. And if you look at real estate as sticks and bricks, and it may have an alternative use, if something goes wrong, it's very hard to make a case for North Dakota. But if you look at North Dakota as a bond, and you say, I'm going to build a hotel or retail or multi-housing there, and I think that this shale gas revolution is going to last for 25 years, I've got a bond that's going to be strong for 20, 25 years, then you can really make the case from an investment standpoint. And you can really make a nice return on it, because the lenders I spoke to that were talking about North Dakota, it wasn't the conduits who I do believe would have an interest in this market. I don't believe the conduits would go there. And so the people that I was speaking to were bridge lenders and sometimes hard money lenders. And so the cost of debt capital to borrow in North Dakota, even for stabilized deals. I was talking to a lender about a hotel deal that had stabilized NOI as recently as 3 years ago of about $400,000. Last year was $4 million, the same hotel, because of just excessive demand. And they're selling it now. But they still can't get debt capital. But the debt capital that they are getting quoted is north of 10%. So to your point, there's great opportunity there, but you should structure your finances in a way that you could try to burn off your equity, certainly over a certain period of time, because North Dakota, come 20 years from now 20 years may be forever from a real estate standpoint, there's no alternative use that's likely. And that's why you have to look at it both as a bond and sticks and bricks.
I don't disagree. I was just at a conference, and they were saying that multi-housing vacancy rates in North Dakota, and even for single-family housing, is like less than 1% currently. But it may just be like it's just more of a temp. To Spencer's point, it depends on when the shale gas, discovery, how long that what our expectations, how long that's going to last.
Sure. Well, look, sometimes when I come up here and I get a deer in the headlights, I just say the Apple Store over and over again and hope that those questions go away, because that's the one store that people consistently say, well, this is the example of retailing in the future. And the guy who's running JCPenney used to run Apple's retail division. I think that the most frequent thing that we're hearing is that those retailers who embrace the internet as part of their distribution chain, rather than fight it, are those that are going to survive. I think most people are thinking that the larger boxes are going to get smaller. JCPenney's been in play now for a year. We get lots of people inquiring as to what's it worth. But I would suggest to you that most of the big boxes that we've seen go dark, we've been able to refill. It's been remarkable. The areas that we've had the most trouble reletting boxes has been the inline space, the smaller spaces, rather than the boxes. To Asieh's point earlier, there's no new development out there. And even markets that may have had some headline issues have strong local market conditions that give us optimism that even if you were to lose a JCPenney, that you could find a way to relet it, given our experience where a lot of these larger retailers are scrambling to find space with new concepts. You might have to break up the box into 2 or 3 boxes, but because I suspected that the footprint for JCPenney is over 100,000 feet.
This is a standalone.
Okay.
They actually own it, but we got the shadow.
Right.
But it still has scrutiny, even though for JCPenney's outside the area. It's a shadow, and there's some leasing limitations.
Sure.
With there.
And I would suggest just 3 things. One, people are optimistic for those retailers that are using the internet as a distribution channel and not as a threat. Second, we've had excellent success nationally in reletting these big boxes. And third, it's very local in nature. If you think you have strong local demand, our optimism on reletting the big box should JCP go dark is higher than perhaps the headlines would lead you to believe.
The medical clinics, that can be a use. But no, I agree. Definitely, the retailers that have an internet strategy. And we are seeing smaller footprints, and we are seeing where the retailers, big box, where they're moving is more into urban centers. So, there is no new supply, and there's going to be a lot of reuses. I'm really bullish on the healthcare being an exit strategy for the underutilized retail space going forward. That's something to think about as an opportunity if something does happen.
Or as one of the users, because we're seeing that in a lot of places. And Asieh is dead right. Our retail folks are saying that is going to be part of the normal tenant mix going forward. The whole tenant mix equation is changing. I was sitting on a panel recently with the head of leasing for GGP, and he was talking about all of the changes that GGP is looking to do in their properties, including some uses like bowling alleys. Okay, bowling alleys used to be, there's still lease restrictions against bowling alleys at a lot of these centers because nobody wants them. Well, people want them now because they want to have different types of uses that drive foot traffic. So the typical ratio of the number of restaurants to other retailers is changing. And just like the tenant mix is changing, but it's not going obsolete. It's just changing. And that's, I think, the way we're suggesting people should look at it. Yes, sir.
Spencer, I see you have a IPO experience with Roots.
Yes.
And I would think in this market, low debt rates, low money market rates, opportunities to buy, if there's money on the sidelines, with no reason to start coming.
Well, I'm glad you asked the question. I actually believe exactly the opposite. And a couple of reasons. First, we've seen 2 leverage buyouts, hostile leverage buyouts for Canadian REITs in the last few months. And REITs had the best cost of capital for the last 4 or 5 years. I don't think that's the case anymore. I think the REIT's cost of capital now is high because they are not prepared to take the amount of leverage that the market is prepared to give them. So I think that what is more likely is you're going to see the attempt to do leverage buyout M&A activity in the REIT space. Some of existing REITs either gobbling up other REITs or more likely private equity firms buying up some of these REITs and putting as much leverage on them as they can. So I think that's going to happen. there are legal challenges. It's very hard to do a hostile takeover in the American REIT space, but that aside, I think that the cost of debt capital will drive a lot of M&A activity in the space. But what we're seeing, which is very interesting, is we're seeing a lot of new REIT activity in other countries. We're seeing American REITs. I have a friend of mine who's a big multi-housing developer who's looking to do a REIT in Canada right now. I just got back from Mexico, and they are doing several new REITs down there. We're talking about REITs in South Africa. We're not talking about a lot of new REIT formation here in the United States. Part of it is the efficiency of capital thing. The other thing, and this is something that Asieh and I debate at great length, is the regulatory environment here in the United States for IPOs is poor, relatively poor as compared to some of the other countries. So even though there are still great efficiencies, so I don't completely disagree with you that there's a lot of logic to seeing more REITs being formed. I think that the cost of debt capital, however, is now boding that the spectrum is now boding more towards private transactions, more M&A like we're seeing in Canada, rather than more IPOs here in the States.
Anybody else? It's about 10 o'clock. We have time for one or two more if you have it.
Mr. Ram?
Lucky?
I think that it's driven by the investors in the bonds that have no better place to put their money. There's insatiable, there's my last big word of the day, Asieh. There's insatiable demand for the AAA paper. And the price of that paper has come down to a point now that they can't issue it fast enough. But also, there's an increase in the number of B-piece buyers. That was really a limiting factor for the last several years, that there just weren't a lot of people willing to take that risk slice. There are many new entrants into that space because on a risk-adjusted basis, if you're going to get up to, call it the 65 to 70% piece of the risk capital stack, and you're able to get close to a double-digit return, that's pretty attractive. And so it's really driven by no good alternative uses and a need to get yield. I mean, there's just too many pension funds out there that need yield. This looks better than a lot of the alternatives. That's what's driving it. The capital markets are driving it. Fundamentals, to Asieh's point, are not driving it, except for possibly a multi-housing.
But to your point, if you look at financial corporations and if you look at their debt loads, back in 2007, 2008, financial corporations in the United States, the share of their nominal debt to nominal GDP was off the charts. It was in bubble territory. And I think the financial community, the banks in general, have done a really nice job because of different reasons for deleveraging their balance sheet. So the bank balance sheets are much healthier right now compared to a few years ago. The Fed's flow data shows that banks are much healthier, so they can go out and provide more loans. And that's part of the reason why, I think they're more willing to give loans. So a lot of the surveys of the top bank officials too shows that the increased optimism and the willingness to give more commercial industrial loans as well. So.
Anybody else? Well, I want to thank everybody once again for making it out in spite of the weather. And thank you very much,
Thank
Asieh
you.
and Spencer.
Bill, thank you.
Great
Thank you.
presentation. I appreciate it.
Thank you.
Thank you.
Thank you, Spencer.
Thank you, Asieh.
Good to
Always
see
great. Good seeing you.
Yeah.